Good morning, everyone. Welcome to this rundown for global stocks and commodities for the 14th of April. A bit of a shorter version this week for two reasons. One, nothing much really changed in the market. The rally continued. The S&P index edged ahead. The Australian market edged ahead. So not a lot changed in the week. And secondly, it was my son's wedding yesterday, and this is a huge weekend for our family. So I'm running a bit short of time. So let's jump into it. The trends remain positive. US earnings season really got underway, particularly on Friday night with the major US banks, JP Morgan, Wells Fargo reporting, and they duly beat expectations quite comfortably. So earnings season has started off very well. Portfolio analyst last week, I provided a perspective on the Australian market, which I think members found very useful. And thanks to a lot of very good questions, there was a long list of stocks analysed. It was a very big addition last week in Portfolio Analyst. So the S&P gained another 14 points, and now it's just 1% off the all-time highs, only another 30 odd points, and we're back to where the market was in September of last year. JP Morgan in particular beat expectations by a considerable margin, and that really confirms the health of the US economy. There's lots of economists and analysts and commentators that project forward and make their predictions about where the US economy is going. And if you want to be bearish, there's plenty of things that you can find to point to. But the reality is that when the world's largest bank beats expectations by a big margin, and they're such heavily covered stocks. I mean, analysts are all over these stocks constantly. So it's very surprising to see such a big earnings beat when the commentary has been so negative. So at the end of the day, I think you really just look at the results and, forget about all the predictions that are being made. The results are where it's at, and JP Morgan came through and delivered in spades. So the bears just keep getting it wrong. There's been a bearish brigade out there since probably 2014 that have been calling an end to this bull market, and they just keep getting it wrong month after month, year after year. So my overwhelming message, as it has been for years, is to follow the trends of the market and not what you think should happen. It's really not a lot more difficult than that. So that's the long and the short of it. And to add to that, breadth has remained very positive. If you look at the number of stocks setting new 52-week highs, if you look at how the Russell 2000 for small caps has been performing, there's nothing wrong with the breadth of this market either. This is not a market that's just being held up by some of the mega cap stocks that are dominating the index. This is very broadly based. So whilst it's always easy, I guess, when the market is so overbought, and it's about as overbought now as you ever get, it's challenging to be to be really relaxed and confident in where the market's going to go in the short term. But moving aside from any short-term fluctuations, things really do look quite positive in the US. US dollar backtracked a little bit last week, and the 10-year Treasury yield got down to about 2.4 a couple of weeks ago, but it's now starting to lift again back up to 2.57. So let's take a look at the S&P. So you can see we had three levels of resistance. The first one here, which was these hikes from the start of the sell-off in October, there was a pause there, then they got taken out. We then got above the second resistance level, which was the blow-off top of January 2018. So we've gone through that, as you can see, with very little pausing at all, no real difficulty at all. And now we've got the all-time highs from September last year are really just a handful of points ahead. And it would be possible for the US market to, particularly the way the earnings season started on Friday night, it would be possible for the US market to get there next week. It is a short week, of course, with Easter, but there's a lot of momentum in this US market at the moment. And if we just look at just on the breadth issues, so this is the Russell 2000. Haven't made it back to the September highs, but still looking fairly positive on the Russell. I'll just take a quick peek at the US dollar. So it's really just in quite a large consolidation between about 95 and 97.5. The Australian dollar, as you can see, we did go up on the week, but we are in a downsloping triangle, and we got up, touched it almost exactly, and then closed down and on the low of the session on Friday night. Let's look at the Australian index, so the ASX 200. There was where we finished last Friday, and we had quite a positive session on Friday of the last week. So I would expect that the Australian market will probably push ahead on Monday. So the Aussie dollar 71.73, and the ASX 200 was up about 70 points, and really no change to what I've been talking about now for months, and that is, probably not a lot of traction in most of the top 100 stocks. You've got to go outside that area, but there's some fabulous stories and some fabulous price moves as well. So I'm finding the Australian market extremely encouraging at the moment. Precious metals, gold, I think might have been down $1, but hardly any move. And with the slightly higher Australian gold price, or the slightly higher Australian dollar, that did pull our gold price back a little bit. GDX down slightly, but really still just consolidating. Copper was up at $2.95, and crude oil continued its run, again defying all the bearish commentary about the global economy, and just a tick under 64 to finish the week. So quite surprising, but here again the lesson is follow the trends in the market. Don't follow what might seem like a very logical and plausible case for markets going one way or the other, because really that matters not. It's where the trend is going. There's the spot copper chart. So we've really just been becalmed there on copper between 290 and 296 for some time now, for some months. But crude oil looking very, very positive. So just to wrap it up, keep building your target list. As I said last week, you need several times as many stocks as you could ever possibly own. If you think you want to own 10 or 12, get a target list of 30. Because the one thing you don't want to do is get your heart set on buying a particular stock and then having to find a justification for why you should buy it. Determine what are sound fundamentals and technical entries, and then let the market come back to you. And if you can only do that if you've got a large enough number of target stocks. And that's certainly the function of all the services that I provide, but in particular, Portfolio Analyst. And some of the members are using that service in a very smart and sensible way, and they're building a target list for the future. They're stocks that they may not consider buying for many, many months, but they're getting things lined up, and that's just the smart way to do it. Portfolio Analyst this week, I'm just going to continue to build the opportunity base, and there certainly are plenty of them in Australia. There's my contact details for any non-members. Short and sweet this week for the reasons that I explained, but it really does look like next week, the shortened week run into Easter will probably be a fairly positive one. So that's it for this week. Cheers.